What's up guys, Raymond here with episode 15 of our financial statement analysis videos in our German industrial stock analysis list. Without further ado, we're going to be analyzing Heidelberg cement, and without further ado, we're going to start off with the key ratios as we usually do. If you're new to my financial statement analysis videos, what we do in these videos are we analyze the what we do in the videos is we analyze the top three financial statements of each company, those being the income statement, the balance sheet, and the cash flow statements. And we look at the key ratios of each statement and attempt to come up with an overall idea of how well the company has done financially in the past up to the present day, and attempt to project how well the company will do in the future, and based on that to determine whether or not the company is a viable investment. So let's start off with the key ratios. The market cap, being the overall price of the company to according to the public market, is 9.89 billion euros. The PE ratio, which is the price divided by the earnings per share, is 7.88, which is really good. I always say the a good minimum PE ratio is should be around 10. If you can get PE ratio stock around 10, that would be a good indicator of a fair market price. Of course, you need to consider other key ratios as well as the factors of each financial statement just to determine to a strong enough degree or to a stronger degree whether or not the company is a good investment at that particular time of analysis. So the revenue figure is the overall sales figure of the last financial year, which is 18.72 billion euros, and the earnings per share, as we saw earlier, was 6.50 euros. So if you get the earnings per share divided by the if you get the earnings per share compared to the general share price, which is 51, you get an overall idea of how expensive the company is. So the dividend yield is 4.69%, which is good. I would say that a dividend yield of 5% is good enough to classify a stock as a healthy dividend stock at that particular time. Of course, as I said earlier, with regards to the PE ratio, you need to consider other factors to be able to determine whether or not the stock is a viable investment. The beta, being the risk level of the stock, which is based on the volatility of the stock up to the present day, is 1.34, which is 34% above the market average of 1, which is generally okay, considering that I've seen beta levels around 1.79, which is almost double the market average. So of course, as with regards to any other ratio, you need to consider everything else. Let's check the income statement, and then we'll move through the balance sheet and cash flow statements. So the income statement, the light purple bar represents the revenue figure, which is the overall sales. In the last financial year, it was around 18.9 billion euros. And as you can see, over the past 3 financial years, it's remained around the same, give or take a few million euros in the 2020 financial year. And in 2019, the profit margin was positive, which was around, I would say, 5%, maybe a bit less, which is definitely good considering that it makes so much revenue. 5%. A 5% profit margin is definitely a good amount, especially if a company can maintain this over a long period of time. In the 2020 financial year, the company managed to lose a bit of or declined a little bit with regards to revenue. It also managed to lose a lot of money with regards to net income. It made a negative profit of around 12%, which is definitely not good with regards to shareholders. I assume this was reflected in the stock price being reduced quite significantly, but it managed to bounce back in the 2021 financial year with regards to an increase in revenue figure by not too much, but a decent amount, considering that the bar represents the billions of euros. So even a tiny increase will represent hundreds of millions. So the revenue figure, the profit margin figure also managed to return back to a positive figure, and he also done a lot better than the 2019 financial year. So the 2021 financial year was the best year that the company had up to this present day, or at least in the past 3 financial years. So the profit margin was around 10%, which is definitely very good. If you can manage to maintain that growth over the next few financial years, then the company will definitely see a positive gain in its stock price. Let's get into the balance sheet just to see how well the company manages its debt as well as its inflow in cash. So the light purple figure represents the total assets, so what the company owns and controls, and the dark purple figure represents the liabilities, what the company owes. So a good ratio would be around 50% or lower, and as you can see, the company's maintained that over the past 3 financial years consistently. So I definitely think that's a positive trait of the company and how well it's done. The managers definitely, as you can see, have a positive, or at least have a focus on maintaining debt levels, or maintaining debt levels that are not too high and not getting out of control. Because if interest is being paid on the liabilities, then with regards to net profit, if you're trying to attract shareholders, shareholders won't necessarily be attracted to your company, which is highly leveraged, simply because interest payments will take up a substantial amount of your net income. So that's definitely something that prospective shareholders take into consideration when analyzing the stock. Let's look at the cash flow statement just to see how well the company manages its cash, how well it does with dividends, etc. Sorry, I'm just going to get back onto that. Financials. So the cash flow statement suggests that the net income, which is the starting line, is 1.95 billion euros in the 2021 financial year. 2020 it was around negative 1.94 billion euros, as we saw in the graph, and 2019 it was 1.27 billion euros. So it managed to maintain around a 10% net income over the past 3 financial years, besides the 2020 financial year. So if you factor in the 2020 financial year's loss, on average it was about 5% for the past 3 financial years. So actually maybe a bit less, maybe about 3.3%. So the cash flow statement starts off with the net income, then it goes to cash flow from operating activities, which was 2.66 billion euros in the 2019 financial year, and it was 2.4 billion euros in the 2021 financial year. The company managed to gain cash, or at least expend cash with regards to investing activities, but in this case it gained 619.8 million euros. Usually you see that it's a negative figure. In almost all cases it's a negative figure, but it managed to gain 2.04 billion euros from other investing cash flows, and they managed to spend 1.42 billion euros on capital expenditures, which is expanding property infrastructure to be able to increase productivity in the future. So lastly, the cash flow from financing activities, or lastly before foreign exchange effects as well as net change in cash, is the cash flow from financing activities. So that's probably the most important part of the cash flow statement. The dividends paid was 436.5 million euros, and the cash flow from financing activities was 280 million euros. The retirement of stock, which means that the company bought back it bought back 350 million euros worth of stock, and it managed to eliminate 1.77 billion euros of debt, which is definitely a very good thing. The foreign exchange effects were 64 million euros. So the company gained 64 million euros in foreign exchange effects. And lastly, the net change in cash. So the amount of cash that the company has on its balance sheet is in its books is 240 million euros. And let's just check how that compares with 2020, which was 671.8 million euros negative, and 2019, which was 957 million euros positive. So if the company managed to maintain that cash balance, which was almost 1 billion euros, the company, I assume, would have had a more positive light to perspective as well as current shareholders. But then again, the company managed to spend a lot of money on capital expenditures as well as reducing debt. So that's definitely a better way of spending cash than keeping it on its books. But keeping cash on its books shouldn't be underestimated. But without further ado, I'm going to close this video. Thank you guys for watching. I will see you in the next one.